clothing allowance 420,000, and leave allowance 1 million. Okay, you could see that the salary is not well structured because his basic salary is so huge and others allowance are very small. However, you see he will be paying a lot on other kind of things like a lot of deduction. Apart from payee, we have NHIS, we have NHF, we have pension deduction. So everything will increases. It will eat hard on him because of his basic is very high. Some organizations have to structure their compensation plan in such a way that the BTH is not too high because of other deductions. So you need to look at it, so that to optimize your pay. But this payroll data is not well optimized, in my own opinion. Okay, but this is what we have, and we all know how we got this figure from our question. For those that are just joining us, I can move back again. How we got the end income is given in the look at the question. The details of the salary per annum as follows. So all this information we have here constitutes the end income. As I was explaining to you that we have this as the details of the salary, those are the end income that we have. So that's how I got my end income. So I'll go back to the case study. Now, apart from the end income, we have the unearned income. The unearned income, we have the rental income. It has a rental income of 9.6 million. And don't forget, I told you about his rental income of 9.6 million. And the expenses, because this is an unearned income, this is like under direct assessment. This is direct assessment part. You need to deduct all the related expenses. This is like the revenue, although it's called income here. It's like a revenue. You need to deduct allowable expenses in line with rent principle that are only reasonably, exclusively, and necessarily incurred to generate this revenue. Example here, general rate 67,500, water rate 96,000 naira, insurance premiums paid 200,000 naira, repair on the property, you repair the property, so it's in line with rent principle, 189,000 naira. Agent commission, the agent is paying for the property 480,000 naira. Mortgage interest, don't forget that it's paying 100,000 naira monthly for 12 months. That's 1.2 million, and it's on that same property. By the time you deduct all these expenses, from the rental income, you will get 7,367,500 naira. And again, there's what we call capital allowances. The capital allowances are agreed with the tax authority, because if you are under direct assessment, you can claim capital allowances, both at the federal level if you are a limited liability company, and at the state level if you are an enterprise or an individual. Okay, so it's the capital allowance here is 840,000. It has been agreed with the state internal revenue services. Now, when you now deduct the total this income here from the capital allowance, okay, we have this particular figure here. So after you have this, you now consider other income he had apart from the rental income. Now he had investments in shares, and he received dividend during the period. But the dividends you are going to look at based on the tax law is the dividend he received prior to the year of assessment. So when it comes to two things, life assurance and dividend received, you consider what has happened prior to the year of assessment. It's not based on the actual year. It's not the dividend you received in 2018 you're going to consider. It will be the dividend you received in 2019, because in 2018, there may still be 2018 is the year of assessment and it's still going on. It could be that another dividend can come in. So, but for 2017, that's what I'm going to consider in 2018. So you only pick the 2017 dividend received of 600,000 and 650,000, add it to its rental income, net rental income, then you see that we have 7,777,500. Okay. Now, if you now add this 7,777,500, don't forget that this man has an employment income. I will show you the employment income in the previous slide. His employment income here is the addition. When you cast all this, addition of all this gives us 61,020,000. This is employment income. Now, apart from he now add his income from from rent. His income from rent is 6,527,500, and he has his income from dividend, another non unearned income, which is the addition of 600,000 plus 650,000. So the total unearned income is 7,777,500. Add it to this earned income, employment income. We have 68,797,500. That's his gross income here. Now, this gross income is where we have the bone of contention now, in the Finance Act. Okay, so this gross income now say, oh, if you want to calculate your consolidated relief allowance, how did you calculate it? Is it based on gross income? Now, in the Finance Act, the consolidated relief allowance now is CRA is usually the higher of 1% of your gross income, or 200,000, plus 20% of your gross income. So that's what CRA is. So basically, your consolidated relief allowance is, for most people, is like, let's say, 200,000 naira, which is the fixed part. There's a fixed part of this allowance, 200,000 naira, plus the variable part is 20% of your gross income. Now, under the new Finance Act of 2020, the gross income has been defined as your income. Okay, then you are going to less your gross income. You are going to less your non-taxable income from your gross income. You are going to less your non-taxable income from your gross income, and you also less tax exempt item. You also less all allowable expenses. You also less capital allowances. So that is the definition of gross income. Okay, some people are in the waiting room. Let me quickly admit them. Okay, so now we have this scenario. Now, in this case, we are not using the Finance Act of 2020.
Yeah, it is 5 marks and
Okay, who is that? Okay, in the Finance Act now, we are not looking at the Finance Act of 2020. We are looking at the Pre-Finance Act now. So in this case, what will be our CRA? Our consolidated relief allowance. We need to know what that will be. It will be 200,000 plus 20% of our gross income. In this case, the gross income we are using here is the Pre-Finance Act, 68,797,500. This is the figure we are using, where my mouse is now. Okay, now when you apply it, you are going to get a CRA of 14,447,475. That's what you will get. Deduct. Now, when you now get this, you are going to also deduct what we call tax exempt item. The tax exempt item are life assurance premium. The life assurance premium in this question, you remember that he insured his life. I will show you the line that tells us about his life. He said that he has a life assurance policy for 7,800,000 naira, on which he pays 710,000 naira annually as what? Premium. And don't forget that I told you that the life assurance premium you are going to claim is the amount you pay on the preceding year. Now we are now claiming this 2018 we are looking at. So the life assurance payment we are looking at is not the one they paid in 2018. However, is the one they paid in 2017. Okay, so but of course this is constant. So we are not taking note of the difference is not so uh, clear. I mean, it will not affect us. But the life assurance policy will pick here will be that of 2017. Okay, so I'll take you back to the solution right now, and you will see that we've claimed the life assurance premium of 710,000 naira. Then we have contribution to National Housing Fund, which is 2.5 of your basic salary, year. Then we have contribution to National Health Insurance Fund, which is 5% of your basic. We have your contribution to pension, which is 8% of your basic housing and transport. Okay, that's from the employee's perspective, not from the employer. You deduct all this from the net income, after the income after deduction.